What I'm about to tell you is going to shock everyone who thinks real estate always goes up, but I'm going to say it anyway because someone needs to tell you the truth. We are heading toward the most devastating real estate crash in modern history. Not a correction, not a soft landing, but a complete collapse that will wipe out trillions of dollars in property values and destroy the wealth of millions of Americans. I've been analyzing real estate markets for over 40 years. I've seen booms and busts, bubbles and crashes, but I've never seen a setup quite like what we're facing right now. The mathematical reality of current property values, mortgage rates, demographic shifts, and economic conditions points to one inevitable outcome: a crash that will make 2008 look like a minor correction. This isn't doom and gloom speculation. This is mathematical certainty based on fundamental economic principles that never change. When asset prices get disconnected from underlying economic value for long enough, reality always reasserts itself violently. And right now, real estate prices are further from economic reality than they've ever been in American history. The people who see this coming and position themselves correctly will have opportunities to acquire real estate at prices we haven't seen in decades. The people who ignore the warning signs and hold on to overpriced properties will watch their net worth evaporate as property values collapse back to levels that actually make mathematical sense. If you own real estate, if you're thinking about buying real estate, or if your retirement plans depend on property values, you need to subscribe to this channel right now and pay attention to what I'm about to reveal. Because understanding what's coming could be the difference between financial survival and complete destruction. Let me start with the most obvious factor driving this coming crash: interest rates that have made real estate completely unaffordable for the majority of Americans. When mortgage rates were 2 and 3%, people could afford much higher property prices because their monthly payments were manageable. But with rates now at 7% and likely going higher, the affordability equation has completely broken down. Here's the mathematical reality. A $500,000 home with a 3% mortgage costs about $2,100 per month in principal and interest. The same home with a 7% mortgage costs about $3,300 per month. That's a 57% increase in monthly payment for the exact same property. Most buyers qualify for mortgages based on their monthly payment capacity, not the total purchase price. When monthly payments increase by 57% for the same property, buyers can only afford properties that cost 57% less, or they're priced out of the market completely. This mathematical relationship is forcing property values down regardless of what sellers want or real estate agents claim. But interest rates are just the beginning. The second factor is demographic shifts that are reducing demand for housing in precisely the markets where prices increased the most during the bubble. Millennials, who drove much of the housing demand over the past decade, are now facing financial pressures that prevent them from buying homes at current prices. Student debt, credit card debt, childcare costs, healthcare expenses, all of these financial burdens are preventing younger buyers from accumulating down payments and qualifying for mortgages at current property prices. Meanwhile, baby boomers who own the majority of expensive real estate are starting to downsize or move to lower-cost areas, increasing supply while demand weakens. This demographic mismatch creates a fundamental supply and demand imbalance. Too many expensive properties owned by older sellers, not enough qualified younger buyers who can afford current prices. When supply exceeds demand persistently, prices fall to levels where supply and demand can balance again. The third factor is the work-from-home revolution that has permanently changed the value proposition of expensive urban and suburban real estate. During the pandemic, people paid premium prices for homes in expensive markets because they thought they needed to live near their offices. Now that remote work has become permanent for millions of jobs, that geographic premium has disappeared. Why pay California or New York prices when you can work the same job from Texas, Florida, or Tennessee? The arbitrage opportunity of high-cost area salaries combined with low-cost area living expenses is driving a massive migration that's reducing demand for expensive coastal real estate while increasing supply as people move away. This trend is accelerating, not slowing down. Companies are realizing they can reduce office expenses by embracing remote work permanently. Employees are discovering they can improve their quality of life dramatically by moving to areas with lower costs and better amenities. The expensive real estate markets that saw the biggest price increases are now seeing the biggest outflows of people and capital. The fourth factor is commercial real estate collapse that's spreading to residential markets through interconnected financial effects. Office buildings, retail centers, hotels, all of these property types are facing structural challenges that are causing massive value losses. Banks that lent against commercial properties are facing enormous losses that are constraining their ability to lend for residential properties. Regional banks, which provide much of the financing for real estate transactions, are particularly vulnerable because they have high concentrations of commercial real estate loans on their balance sheets. As these loans default and properties lose value, banks become more cautious about all types of real estate lending, reducing credit availability for residential buyers. The commercial real estate crisis also affects residential markets through municipal finances. Cities and towns that depend on commercial property tax revenues are facing budget shortfalls that require higher residential property taxes or reduced services. Either outcome reduces the attractiveness and affordability of residential real estate in affected areas. The fifth factor is inflation and cost of living pressures that are forcing people to choose between housing costs and other necessities. When food, energy, healthcare, and transportation costs are rising faster than incomes, people have less money available for housing expenses. This forces them to seek cheaper housing options or delay home purchases entirely. The relationship between housing costs and other living expenses creates a ceiling for how much people can actually pay for real estate regardless of current market prices. When total living costs exceed income capacity, something has to give, and it's usually housing costs because they represent the largest discretionary expense for most families. The sixth factor is leveraged speculation that artificially inflated property values during the bubble years. Investors using borrowed money to buy properties for rental income or appreciation drove prices beyond what owner-occupants could afford based on their actual housing needs. This speculative demand created artificial scarcity that pushed prices to unsustainable levels. As interest rates rise and rental yields fail to cover mortgage payments, speculative investors are being forced to sell properties to cut their losses. This creates a flood of inventory hitting the market simultaneously, overwhelming the limited number of qualified owner-occupant buyers and forcing prices down rapidly. The speculative unwinding is particularly severe in markets that saw the biggest price increases during the bubble. Cities like Austin, Boise, Phoenix, Las Vegas, markets where investors drove prices up, assuming that appreciation would continue indefinitely. As these investors exit, prices are falling back to levels that reflect actual local income and employment fundamentals. Now let me show you the mathematical inevitability of this crash by breaking down exactly which markets will be hit hardest and when the collapse will accelerate. Because this isn't going to be a uniform decline across all markets. Some areas will see devastating crashes of 50% or more, while others might only decline 20 to 30%. Understanding these differences could save you hundreds of thousands of dollars. The markets most vulnerable to severe crashes are those with the highest price-to-income ratios, the biggest speculative bubbles, and the most dependence on industries that are being disrupted by remote work and artificial intelligence. I'm talking about San Francisco, Los Angeles, Seattle, Portland, Austin, Miami, and parts of New York that saw massive price increases during the pandemic bubble. In San Francisco, median home prices reached over $1.5 million, while median household incomes remained around $120,000. That's a price-to-income ratio of 12 to 1, compared to the historical norm of 3 to 4 to 1. For prices to return to sustainable levels based on local incomes, properties would need to fall 60 to 70% from peak values. Los Angeles faces similar mathematical problems with median prices around $900,000 and incomes around $70,000. The disconnect between what local residents can afford and what properties cost is so extreme that only outside speculation and borrowed money can sustain current prices. When that speculation ends, prices must fall to levels that local buyers can actually afford. Boston provides a perfect example of what happens when speculative bubbles collapse. Home prices doubled in just 3 years, driven primarily by investors and people relocating from more expensive markets. But as remote work stabilizes and the initial relocation wave ends, Austin is left with property prices that far exceed what local salaries can support. prices are already falling and they have much further to go. The timeline for this crash is accelerating faster than most people realize. We're already seeing the early warning signs in inventory buildup, price reductions, and transaction volume declines. But the real acceleration will begin when forced selling starts as investors and over-leveraged homeowners face financial pressure they can't manage. Here's how I expect the crash to unfold. Phase 1, which we're in now, involves gradual price declines and increasing inventory as motivated sellers try to exit before conditions worsen. This phase can last several months as sellers slowly reduce their expectations and buyers wait for better opportunities. Phase 2 will begin when forced selling accelerates due to mortgage payment stress, investment losses, and economic recession. This is when prices will decline rapidly as sellers compete desperately for the limited number of qualified buyers. I expect this phase to begin in late 2025 and accelerate through 2026. Phase 3 will be the capitulation phase where prices fall to levels that attract bottom fishing buyers and investor interest. This might not occur until 2027 or 2028, depending on how severe the recession becomes and how long it takes for economic conditions to stabilize. But the crash won't be limited to residential real estate. Commercial properties are already showing severe stress, and this will accelerate the residential decline through multiple channels. Office buildings in major cities are trading at 50 to 70% discounts to their pre-pandemic values because remote work has permanently reduced demand for office space. Retail properties face similar challenges from the continued growth of e-commerce and changing consumer behavior. Shopping malls, strip centers, and standalone retail buildings are becoming obsolete as people shop online instead of visiting physical stores. This creates massive oversupply of commercial space that can't be converted to other uses economically. The commercial real estate crisis affects residential markets through bank lending constraints, municipal budget pressures, and general economic confidence. When commercial properties lose half their value, the banks that finance them face enormous losses. These banks then reduce lending for all types of real estate, including residential mortgages. Local governments that depend on commercial property taxes face budget shortfalls that force them to raise residential property taxes or cut services. Both outcomes make residential real estate less attractive and affordable for potential buyers, putting additional downward pressure on home prices. Here's the mathematical reality that real estate optimists refuse to acknowledge. Property values cannot remain permanently disconnected from the underlying economic fundamentals that determine what people can actually afford to pay. These fundamentals include local employment, average incomes, interest rates, and the cost of alternative housing options like renting. When you analyze current property prices against these fundamentals, the overvaluation becomes obvious. In most expensive markets, buying a home costs 2 to 3 times more per month than renting an equivalent property. This relationship is unsustainable because rational buyers will choose the cheaper option until prices decline to eliminate the arbitrage opportunity. The rental market provides a reality check for property values because rents are determined by what people can actually afford to pay from their current incomes. When purchase prices imply monthly costs that are double or triple equivalent rental costs, you know property values are in bubble territory that must eventually correct. Interest rate changes amplify these fundamental disconnects exponentially. A 1% increase in mortgage rates reduces buying power by approximately 10% for payment-constrained buyers. Since most buyers qualify based on monthly payment capacity rather than total purchase price, higher rates force property values down proportionally, with mortgage rates likely to remain elevated or go even higher as the Federal Reserve fights inflation. The downward pressure on property values will persist until prices fall to levels where monthly payments become affordable again at current interest rates and income levels. The leverage in the system makes this crash much more dangerous than most people understand. During the bubble years, buyers used minimal down payments, interest-only mortgages, and other high-risk financing to purchase properties they couldn't actually afford with traditional financing. Investors used borrowed money to buy multiple properties based on projected appreciation and rental income that may not materialize. When property values decline, highly leveraged buyers quickly find themselves underwater on their mortgages, owing more than their properties are worth. This creates strong incentives to default or walk away from properties, especially for investment properties that are generating negative cash flow. The foreclosure process adds additional downward pressure on property values because foreclosed properties typically sell at significant discounts to market rates. As foreclosure inventory increases, it creates competition for traditional sellers who must reduce their prices to compete with distressed property sales. Government intervention cannot prevent this crash because the underlying mathematical problems are too large to solve with policy changes. Even if the Federal Reserve cuts interest rates aggressively, which would reignite inflation, property values have become so disconnected from incomes that significant declines are inevitable. Mortgage payment assistance programs, first-time buyer subsidies, and other government interventions might slow the decline temporarily, but they cannot solve the fundamental affordability crisis that requires either massive income increases or substantial property value decreases to resolve. The global nature of this real estate bubble makes the coming crash even more severe because international buyers who drove prices higher in many markets are now exiting simultaneously. Chinese buyers, Canadian investors, European speculators, all of these international capital flows that inflated property values are now reversing as global economic conditions deteriorate. This international capital flight is already visible in luxury markets in cities like Vancouver, London, Sydney, and New York, where foreign buyers drove prices to extreme levels during the bubble years. As these buyers exit to preserve capital during global economic uncertainty, they're leaving domestic markets without the external demand that supported inflated valuations. Now, let me tell you exactly how to protect yourself from this coming crash and position yourself to profit from the opportunities that will emerge. Because every real estate crash creates massive wealth transfer from people who are unprepared to people who understand what's happening and position themselves correctly. If you currently own real estate in high-risk markets, your priority should be reducing your exposure before the crash accelerates. This doesn't mean panic selling at any price, but it does mean being realistic about current market conditions and getting ahead of the selling pressure that's building. Here's my specific strategy for current property owners. First, if you own investment properties that are generating negative cash flow or barely breaking even, sell them immediately. Don't wait for prices to recover because they're not going to recover for years. Take whatever you can get now and redeploy that capital into assets that will hold their value during the crash. Second, if you own your primary residence in a high-risk market and have substantial equity, consider selling and renting temporarily while the crash plays out. I know this goes against conventional wisdom about homeownership, but conventional wisdom assumes markets that go up and down cyclically rather than crashes that reset values permanently. The psychological resistance to selling your home is enormous, but remember that your house is not just your home, it's also your largest financial asset. If you wouldn't buy your house today at current market prices, which most people wouldn't, then you shouldn't own it at current market prices either. Third, if you must keep your primary residence, ensure you have fixed-rate financing and substantial equity cushion. Adjustable rate mortgages will become deadly as interest rates remain elevated. High loan-to-value ratios will leave you underwater when property values decline. Position yourself to weather the storm rather than hoping it won't happen. For people who don't currently own real estate, this crash will create the buying opportunity of a lifetime. Properties that are unaffordable today will become attractively priced as desperate sellers compete for scarce qualified buyers, but you need to prepare now to take advantage of these opportunities. Start building substantial cash reserves that you can deploy when prices reach attractive levels. This means delaying gratification now to have buying power when everyone else is financially stressed. The investors who made fortunes buying real estate during previous crashes were those who had cash available when motivated sellers needed to exit quickly. But don't try to catch a falling knife by buying too early in the crash. Real estate crashes unfold over years, not months, and prices usually fall much further than most people expect. Wait for genuine distress selling and prices that reflect realistic income and rental yield calculations. Here's my criteria for buying real estate during the crash. Properties must cash flow positively from rental income at purchase prices, assuming realistic vacancy rates and maintenance costs. Purchase prices should reflect price-to-income ratios consistent with historical norms for the local market. Sellers must be genuinely motivated by financial pressure rather than just testing the market. The best opportunities will emerge in markets that have strong underlying economic fundamentals but got caught up in speculative bubbles. Cities with diversified economies, growing employment bases, and reasonable cost structures, but where property prices got inflated by speculation and easy credit. Avoid markets that face long-term structural challenges like declining populations, single industry economies, or areas with persistent outmigration. Even crash-level prices won't make these markets attractive if the underlying economic trends are negative. The rental market will provide excellent opportunities during the crash as foreclosed homeowners become renters and credit constraints prevent people from buying. Focus on properties that appeal to displaced former homeowners rather than traditional rental demographics. These tenants typically take better care of properties and pay rent more reliably, but real estate isn't the only opportunity created by this crash. The broader economic disruption will create opportunities in other asset classes as panic selling depresses prices across multiple markets. Stock market investors who understand the cycle can position themselves to benefit from oversold conditions. Financial sector stocks will be particularly attractive during the crash because banks and REITs will trade at severe discounts despite many having strong underlying businesses. Insurance companies, mortgage servicers, and other real estate-related businesses will become available at bargain prices for investors with patience and analysis capabilities. The crash will also accelerate innovation in construction, financing, and property management as the industry adapts to new economic realities. Companies that provide solutions for distressed properties, alternative financing, and cost-effective construction will see growing demand as the market adjusts to affordability constraints. Here's what I want you to understand about the timing of this crash. It's not a question of if, it's a question of when the acceleration phase begins. The mathematical forces I've described are already in motion and gaining momentum. Every month that passes brings us closer to the point where gradual decline becomes rapid collapse. The people who recognize this now and position themselves accordingly will have enormous advantages over those who wait until the crash is obvious to everyone. By the time mainstream media acknowledges the severity of the real estate crisis, the best opportunities for protection and profit will already be claimed. Don't make the mistake of assuming government intervention can prevent or significantly moderate this crash. Politicians will try various programs to support property values, but the scale of the bubble is too large for policy fixes to solve. The mathematical relationship between incomes, interest rates, and property values must be restored regardless of political preferences. The Federal Reserve faces an impossible choice between fighting inflation and supporting asset prices. If they cut rates to support real estate, they'll reignite inflation that destroys purchasing power for everyone. If they keep rates high to fight inflation, they'll accelerate the real estate crash. Either way, property values must adjust to reflect economic reality. Local governments will try to help through zoning changes, tax incentives, and first-time buyer programs, but these measures can't solve fundamental affordability problems. When median home prices are 8 to 12 times median incomes, small policy adjustments won't restore market balance. The most important psychological preparation is accepting that this crash is necessary and healthy for long-term economic stability. Artificially inflated property values don't create real wealth, they just transfer wealth from buyers to sellers and create unsustainable debt burdens that eventually collapse. When property values reset to levels that working families can actually afford, it will restore economic balance and create opportunities for sustainable homeownership. The pain of the crash will be severe but temporary. The benefits of affordable housing will last for years. Here's my final recommendation. Start implementing these protective strategies immediately, but don't try to time the market perfectly. The exact timing of crash acceleration is unpredictable, but the direction is certain. Begin reducing exposure to risky real estate positions now while building resources to capitalize on opportunities later. If this analysis has convinced you that a major real estate crash is inevitable, share this video with anyone who needs this warning. Property owners deserve to understand the risks they're facing. Potential buyers deserve to know that patience will be rewarded with much better opportunities. Subscribe to this channel and hit the notification bell because I'll continue monitoring real estate markets and providing updates as this crash unfolds. The people who understand what's happening and position themselves correctly will have enormous advantages during this transition. Leave a comment below and tell me whether you're planning to reduce real estate exposure or build cash reserves for buying opportunities. The community of people who see this crash coming needs to support each other through the challenging period ahead. Remember, real estate crashes are wealth transfer events, not wealth destruction events. Money doesn't disappear, it just moves from unprepared sellers to prepared buyers. The question is which side of this transfer you want to be on. Position yourself now while you still have time to prepare. The crash is coming whether you believe it or not. The only question is whether you'll be ready when it arrives. Make the choice to protect yourself and your family from the financial devastation that's approaching. The time for denial is over. The time for action is now.